For decades, the world spoke about China in superlatives. The fastest builder of cities in human history. The greatest poverty reduction ever recorded. The factory of the world, humming day and night, feeding the shelves of every supermarket from California to Cairo. To investors, it looked like destiny. To policymakers, it looked like a miracle. To many ordinary people, it looked unshakable. But every miracle has a ledger. And somewhere, far away from the shining skylines and export numbers, that ledger has been quietly filling with something far less glamorous. Not a stock market crash, not a simple trade war, but a slow, dense accumulation of obligations, promises, and risks. A hidden chain of IOUs running through the bones of the world's second-largest economy. A financial time bomb buried not in one place, but everywhere at once. Today, we're going to rewind the story behind that bomb. 5 pressure points. 5 cracks in the facade. And why, when they finally converge, the shock won't just be China's problem, it will be everyone's. Look at China's skyline, and you see confidence turned into concrete. High-speed trains slicing across provinces. Airports that look like sci-fi terminals. Endless ring roads, glass towers, suspension bridges cutting over brown rivers. But if you zoom out from the postcard image, you notice something else. Some highways are strangely empty. Some industrial parks never quite fill. Some glittering districts go dark at night. Behind that silence is a math problem. For years, Beijing had a simple message for its provincial and city leaders. Grow. Hit the GDP targets. Build, expand, make the numbers go up. And local officials listened. Because in China's political system, growth isn't just a statistic, it's a career ladder. Promotions, prestige, survival, all linked to whether you can make your patch of land look more prosperous than last year. The easiest way to do that? Pour concrete. Airports, stadiums, bridges, industrial parks, these are visible, countable, photographable. They show up in official statistics. They impress visiting delegations. They can be pointed to and claimed as success. There was only one problem. Local governments in China don't have much freedom to raise their own taxes. Beijing keeps tight control over the most lucrative revenue sources. So local officials did what governments around the world often do when they want to spend money they don't officially have. They invented a workaround. They called it the Local Government Financing Vehicle, LGFV. On paper, an LGFV is just a company. In reality, it's a mask. These special purpose entities were created to borrow money on behalf of local governments. They issue bonds, take out loans, raise funds, then use that money to build roads, rail lines, business parks, entire districts. The genius of the design is that the debt doesn't show up directly on the official government balance sheet. It lives in the shadows, in a gray zone between public and corporate finance. On paper, the finances looked manageable. In reality, the obligations piled up like ice beneath the surface of a frozen lake. No one can say for sure how deep it goes. Official statistics only hint at the scale because much of this borrowing never appears in the standard budget documents. But independent analysts, parsing bond filings and local records, estimate that China's local government debt, including these off-balance sheet LGFVs, has swelled into the tens of trillions of dollars, more than the entire GDP of Japan. If this sounds familiar, it should. In the 2000s, Western banks stuffed their balance sheets with mortgage-backed securities that didn't look dangerous until they suddenly did. In China, the instruments were different. The system is more controlled, but the underlying pattern rhymes. Risks repackaged, shuffled away from view, while everyone tells themselves that as long as growth continues, the music won't stop. For a while, the machine worked. The magic fuel was land. In China, the state technically owns all land, but it can sell land use rights to developers. So local governments became, in effect, giant land dealers. They would take a piece of farmland or an old neighborhood, rezone it, and auction off the rights to a developer hungry to build apartments, malls, or office towers. The proceeds from those auctions became the lifeblood of local finance. Cash from land sales was used to service LGFV debts, start new projects, and keep the appearance of perpetual motion. Developers borrowed to buy land. LGFVs borrowed to build infrastructure to support the new developments. Banks lent to both, assuming that as long as property prices rose and construction continued, everyone would be repaid in the end. This is what a debt-driven boom looks like from the inside. No single step feels reckless because each step is justified by the last 10 years of growth. The past becomes the proof that the future can only be bigger. But booms have a habit of turning fragile precisely when they seem most permanent. As China's property market began to slow, land auctions started to fail. Developers, no longer confident they could sell new apartments at ever higher prices, pulled back. The once roaring river of land sale revenue shrank into a stream. The debts, however, did not shrink. Bonds still had to be rolled over. Interest still had to be paid. Projects still had maintenance costs. The math that had been hidden in footnotes now began to stalk the main text. There's another problem with debt in the dark: fear. Because LGFVs sit in that murky space between government and company, nobody outside the inner circles in Beijing can clearly see who owes what to whom. Domestic banks, many of them state-owned, hold large piles of LGFV bonds. Trust companies and other institutions are exposed too. But how much risk is concentrated in which region, under which projects, on which balance sheets? Investors, analysts, even regulators struggle to get a full view. The result is opacity. And in finance, opacity is its own kind of risk. Markets can price bad news. What they struggle to price is uncertainty. If just a handful of LGFVs failed to roll over their loans, it could trigger a chain reaction of doubt. Are other vehicles in trouble? Are local governments still standing behind them? Will Beijing step in, or will it let some of them fall to teach a lesson? Fear spreads faster than any official press release. First through domestic banks and bond markets, then through foreign funds holding Chinese debt, then potentially through global markets suddenly forced to ask if the world's supposed engine of stability has been hiding a much shakier foundation. This is why local government debt in China is not just a technical accounting issue. It is a question of credibility. For decades, the Chinese leadership has projected an image of control, a steady hand on the wheel. Crises may happen elsewhere: Wall Street, Europe, emerging markets. But in Beijing, the narrative is different. The state is in charge. The system is stable. We can always manage the risks. When local governments begin to default openly on a large scale, that carefully crafted image begins to crack. And in a system where political legitimacy is deeply intertwined with economic performance, even a small crack can become dangerous. History shows this again and again. In the late 1980s, Japan entered its own era of hidden losses. Banks stuffed with bad loans tied to property and stocks. Politicians promising that everything is under control. It took a full decade for the illusion to fully break, and the result was the so-called lost decade. Years of stagnation, shrinking confidence, and a financial system that could never quite clean itself up. China's leaders know this history well. They studied it. They vowed not to repeat it. But the paths of nations often resemble each other more than they would like to admit. A boom built on rising asset prices. Real estate in China didn't simply grow, it ballooned. From the late 1990s to the mid-2010s, it became one of the greatest construction booms in human history. New skylines rose in places that had been villages barely a decade before. Developers raced each other across provinces, buying land faster than they could draw blueprints, pre-selling apartments before the foundations were even poured. At the heart of this frenzy was a belief that seemed unshakable. China could not run out of demand. Urbanization, rising incomes, and cultural expectations all pointed to one conclusion: more apartments, more construction, more growth. But every great boom has its keystone player, and in China, that player was Evergrande. Evergrande wasn't just a company, it was a symptom, the embodiment of an era of debt-fueled expansion. At its peak, it had more than 1,300 projects in over 280 cities. It owed over $300 billion, more than the GDP of some countries. Its strategy was simple and dangerously effective. Buy land early, build often, pre-sell aggressively, borrow relentlessly. The model worked as long as the market rose. Evergrande wasn't alone. Companies like Country Garden, Sunac, Kaisa, and Fantasia all adopted similar playbooks. But in 2020, Beijing introduced the 3 red lines. Stricter rules limiting how much developers could borrow. It was meant to cool an overheating sector. Instead, it became the trigger that exposed years of accumulated fragility. Developers suddenly found themselves cut off from easy credit. Pre-sales slowed as buyers became worried. Suppliers went unpaid. Construction stalled. Families protested, refusing to pay mortgages on unfinished apartments, an unimaginable act in a country where financial rebellion is rare. Then, in late 2021, it happened. Evergrande defaulted, the largest corporate default in China's history. It was like watching a giant fall in slow motion. For the first time in decades, the illusion cracked. Property prices could fall and developers could collapse. By 2024, the damage was unmistakable. Property sales fell by more than 20% from their peak. New construction hit its lowest levels in over a decade. For many families, this wasn't just an economic correction. It was existential. In small and mid-sized cities, where most of China's population lives, prices dropped 15 to 20%. Entire life savings evaporated on paper. The psychological blow was severe. When people feel poorer, they spend less, invest less, and retreat into caution. China's youth unemployment hovered above 14%, and consumer confidence, already battered by pandemic lockdowns, plunged further. This is where the danger lies. Not in a sudden crash, but in a long, quiet stagnation. The kind Japan lived through after 1990. A slow erosion of optimism. A generation that begins to doubt that their future will be better than their parents'. A society that starts saving defensively instead of spending confidently. A stagnating real estate sector means weakening developers, rising bad loans at banks, and declining trust in one of the central pillars of the Chinese economic model. Once the belief that homes always rise in value dies, it's almost impossible to resurrect. But the shadows run deeper. Because behind the official banks and state institutions lies another system, a parallel world of money that most outsiders rarely see. Shadow banking. A vast, loosely regulated ecosystem of trust companies, wealth management products, corporate loans, and underground lenders. It doesn't look dangerous at first glance. In fact, many of the products are sold like luxury items. Glossy brochures, promises of guaranteed returns, sales pitches that sound almost state-endorsed. But behind the polished exterior lies a more volatile truth. Much of the shadow capital flows into exactly the sectors now under strain. Real estate projects that banks won't touch, or local government financing vehicles struggling to service debt. And the money fueling this system? Not Wall Street, not institutional investors, but middle-class families. Millions of ordinary citizens poured their savings into shadow products, believing, sometimes explicitly told, that they were safe, that the state would step in if anything went wrong. But there is no formal guarantee. And when defaults occur, that truth reveals itself brutally. In 2023, Zhengzi Enterprise Group, one of the biggest players in the shadow banking world, announced it couldn't repay billions. Ordinary citizens suddenly found their life savings frozen, possibly lost. The shock was emotional as much as financial. It felt like a breach of trust, a violation of the unspoken pact between the state and its people. We save, you protect. The scale of shadow banking is enormous. At its peak, it was estimated at over $12 trillion, roughly the GDP of the European Union. Even after regulatory crackdowns, it remains a multi-trillion-dollar force. And because it is intertwined with both real estate and local government borrowing, one failure can quickly cascade into many. Opacity makes it worse. Loans disguised inside other loans, investments hidden inside products within products, money shifting through layers of entities to avoid oversight. It behaves, as one analyst described, like water. Block one channel, and it flows into another. Close one loophole, and a new one appears. This is not just a financial risk. It is a social one. If defaults spread, protests could follow. Capital could flee the country faster than regulators can contain. And once public confidence is truly shaken, it becomes harder to restore than any bridge or housing complex. But the shadows hide one more pressure point, one more mechanism of quiet fragility: corporate debt. The debts we can see on official balance sheets. The debts of companies that exist not because they are productive, but because they are protected. Zombie companies. These are the factories, mines, and state-owned enterprises kept alive through constant refinancing. Firms that generate just enough cash to pay interest, but not enough to innovate, compete, or meaningfully grow. For years, they survived thanks to cheap credit. Banks were pressured to lend to them. Local governments needed them to maintain jobs. Shutting them down would mean unemployment, and unemployment can mean unrest. So the loans continued, year after year. A slow, quiet accumulation of unproductive debt. Now, interest rates are rising. Global demand is slowing. Margins in heavy industries, steel, shipping, construction, are razor thin. Defaults that were once unthinkable are becoming common. Some are quiet restructurings. Others are messy, with unpaid workers protesting outside factory gates.
Corporate debt in China now is around 120% of GDP, one of the highest ratios in the world. And many of the firms holding that debt are not healthy companies. They are placeholders, economic ghosts, kept alive because letting them die would reveal too much truth at once. When these zombies finally collapse, they take jobs, regional economies, and bank balance sheets down with them. And when you combine that with the fragility of shadow banking, you start to understand why economists worry about a cascading crisis, a chain reaction, silent at first, then unstoppable. But the deepest fault line in China's financial time bomb is not economic at all. It is demographic.
Demographics are destiny, economists like to say. For China, a nation that once reshaped the global economy with its vast workforce, that destiny has taken a sharp and unexpected turn. For decades, China's growth did not come from miracles or ideology alone. It came from people. A tidal wave of working-age citizens who migrated from countryside to city, from farms to factories, from low productivity to high output. It was the greatest human migration in modern history. And it powered everything: construction, manufacturing, exports, consumption. But around 2012, something subtle began to change. China's working-age population quietly peaked. The demographic engine that had carried the nation for 3 decades began to slow and then reverse. By 2022, for the first time in more than 60 years, China's population shrank. And in that same year, India surpassed China as the world's most populous nation, a symbolic milestone that hinted at a deeper shift in global economic gravity. Today, China's fertility rate sits near 1.3 births per woman, far below the replacement level of 2.1. In major cities like Shanghai, it's even lower. Even generous incentives, cash bonuses, tax breaks, housing subsidies haven't reversed the trend. The cost of raising a child is too high, the competition too fierce, the economic future too uncertain. Many young couples simply opt out. The consequences are already visible. China now has millions fewer workers than it did just 5 years ago. Meanwhile, its elderly population is soaring. By the mid-2040s, the number of citizens over 65 will double, swallowing an ever larger share of national resources. This is not just a social challenge. It is a financial pressure point, one that cuts directly into China's economic model. An aging society means higher pension costs, rising healthcare spending, fewer taxpayers, slower consumption, weaker GDP growth. And slower growth means lower revenues, precisely when the country must service massive debts accumulated by local governments, state-owned enterprises, and property developers. It is a demographic squeeze not unlike Japan's in the 1990s, but happening on a larger scale, at a faster pace, with deeper financial entanglements. In Japan, the bust created a lost decade. In China, the risk is that demographic decline accelerates the very financial stresses already building beneath the surface. When fewer young workers buy homes, property markets stagnate. When older citizens tighten spending, consumption weakens. When tax revenues fall, debt burdens grow heavier. It is all one interconnected system, and when one part slows, the others strain. But demographics aren't the only external pressure. There is one more force pressing against China's financial time bomb, a force shaped not by markets but by geopolitics. U.S.-China tensions have evolved far beyond tariffs and trade disputes. They have entered the realm of finance, technology, and capital flows. Some scenarios being discussed by analysts verge on the extreme. American investors being forced to unwind roughly $800 billion of Chinese equity holdings, cross-border listings being blocked, capital channels closing in both directions. China's most advanced tech firms, once symbols of its rising power, now face global export restrictions, semiconductor bans, supply chain realignments, strategic competition that grows more rigid each year. When a nation faces rising geopolitical uncertainty, it often turns inward. China's policy response has increasingly leaned on domestic stimulus, infrastructure spending, credit expansion, and state-directed investment. But this is precisely the pattern that inflated its current debt risks. Debt-fueled growth is a short-term fix that deepens long-term fragility. Then comes the currency dilemma. The yuan remains tightly managed, but Beijing stands between two bad options. Let it weaken significantly. This risks triggering capital flight, wealthy citizens and businesses rushing their money overseas, a threat China has struggled with before, especially in 2015-2016. Keep it artificially strong. This hurts exports, creates financial distortions, and signals to investors that the state is fighting the market. Never a reassuring sign. Either scenario chips away at confidence. And in modern finance, confidence is the oxygen that keeps the system alive. Once it thins, things can unravel fast. So, what happens if China's financial time bomb goes off? What does the shockwave look like? Domestically, the consequences would be immediate. Defaults across local governments, collapsing property developers, failing zombie companies, rising unemployment, a blow to household wealth and consumer spending, social unrest in a country accustomed to stability. But the shock doesn't stop at China's borders. Across Asia, nations tied to Chinese demand, Korea, Japan, Vietnam, Malaysia, would feel exports plunge. Commodity exporters from Australia to Brazil would watch iron ore, copper, and oil prices collapse, punching holes in national budgets. Global investors holding Chinese bonds and equities would take heavy losses, shaken confidence in emerging markets worldwide. No country is big enough to collapse quietly, and China is too deeply woven into global supply chains, financial networks, and commodity markets to fail without consequences. So, what does Beijing do? In the short term, it stabilizes, it rescues, it applies pressure to banks, restricts capital outflows, injects liquidity, deploys state-owned giants to quietly absorb losses. In the medium term, it restructures debt, it merges failed developers, it forces slow-motion deleveraging, a long, grinding process that keeps the system alive but sluggish. But in the long term, China faces a choice that every major economy eventually confronts: the choice between growth fueled by debt and growth fueled by productivity. That means rethinking capital allocation, allowing unhealthy firms to fail, curbing shadow banking, reforming local government incentives, adapting to an aging society, strengthening social safety nets, restoring household confidence. These are structural reforms, deep cuts, not cosmetic bandages. And like all profound reforms, they come with political risk. Yet without them, the explosion becomes less a question of if and more a question of when. China's rise reshaped the world. Its slowdown will reshape it again. No economy this large rewrites its trajectory without sending ripples through every continent, every market, every boardroom. The truth is simple and sobering. China is too big to fail quietly, too interconnected to stumble without dragging others with it, too important to ignore, yet too opaque to fully understand. A financial time bomb is not defined by when it explodes. It is defined by how many fuses are burning at once. And in China today, those fuses are everywhere. In its cities, in its companies, in its banks, in its households, in its population charts, in its geopolitics. The question the world must now ask is not whether the shock will be felt, but whether anyone is prepared for it. Because when giants tremble, the ground shifts far beyond their borders.